We didn't expect meddling with the rates as far as the capital gains is concerned.
Yeah.
So that came as a negative surprise for the market.
All right, let's now move on to understand a little bit about the impact on the stock market, because obviously the knee jerk reaction as far as the markets were concerned was negative to especially the hiking of the long term capital gains. But over the long term, what now can we expect going forward? Ambareesh Baliga is joining me here on the show. Ambareesh, if my voice is reaching you, thank you so much for taking the time out and speaking to us. Your thoughts, because I think a hike in capital gains tax was not what too many people were expecting. The status quo was more what was being expected at this point in time. But your
Right.
thoughts?
No, I mean, clearly we didn't expect meddling with the rates as far as the capital gains is concerned.
Yeah.
So that came as a negative surprise for the market. I mean, although we were expecting something for the F&O side of the market, which is the speculative side of the market, we were expecting some increase in taxes. So that came in terms of STT, which is fine to a certain extent. But capital gains increase was surely not expected. So that is sort of negative for the markets. At the same time, the buyback of shares, which was quite prevalent and was a decent way of paying back or paying dividends to investors. I think that route will be closed from 1st of October. So that's the other one which is negative for the markets.
Also, the at least what was mentioned in the economic survey and what we've been seeing in the past, the comments that have been coming in from SEBI, from Finance Minister about the FNO segment and how they're really not happy with the way it's picked up pace. So there was a lot of expectation that something more drastic would be done this time round to curb that,
Absolutely.
but that really hasn't come in, except a small hike in STT. Well, not small,
Yeah.
but still, except the STT hike. So, what do you have to say?
No, in fact, I mean, I was personally expecting a special tax slab for the F&O segment of the market, which could be higher than the highest marginal slab. So since that has not come in, so I think I mean the sort of speculation which goes on in the on the F&O side, especially for the retail, I think that's where the worry is. I think that will continue. I think we'll need to wait and watch as to what SEBI does, because this was beyond the purview of the budget. That it's possible that SEBI could increase the minimum lot size further. So I think that could be done to at least avoid retail getting into this in a very big way. So I think that's what we need to wait and watch out for.
Right, right. But do you believe that the hike in long-term capital gains will have any material impact on perhaps bringing down the overheating of the market, which is something that looks like that the government wanted to do at this point in time?
No, see, I mean, sentimentally, it's a bit negative. But then, end of the day, you're paying capital gains tax when you're making profits. So,
Yeah,
and I suppose this will affect the short term more than the long term. I'll explain that because
yeah.
short term, the tax is going up by nearly 5%. Yeah, but then end of the day, you are paying that 5% more only if you're making more. I mean, if you're making profits. So to a certain extent, over a period of time, I think this will get absorbed by the markets. And when you talk of a long-term capital gains tax, although it's increased from 10 to 12.5, but at the same time, we have seen that I mean the minimum slab where you get an exemption has been increased from 1 lakh to 1 lakh 25,000. So this
Yes.
25,000 increase takes into account up to either 10 lakhs more of long-term capital gains profits. So for a regular retail investor, I mean, up to like another 10 lakhs of profits, you're decently hedged in the sense you're not paying more than what you're paying earlier. So only if you're making more than 10 lakhs profits beyond your regular one, I think that's when it'll start hurting you. But then again, like I said, if you're making profits, you end up paying tax. So that's fine.
Right. Amrish, what is your own sense, this fear that SEBI has, the government has talked about with regard to FNO, the way people are getting into FNO, and a lot of people, of course, are making losses. But at the end of the day, should the government be doing things to reduce that? Because it is a free country. People can trade and do things that they want to do out of their choice. They're being given all the information. So should there be regulatory intervention in something like this, or should there just be awareness as an effort to tell people the negative impact of this and then leave it to them to decide?
No, I mean, see, when you're talking of free country and end of the day you're putting your own money, you should be allowed to do whatever you feel like. By the same time, I mean, as a regulator, as a government, I think it becomes your duty to at least course correct people who are possibly going on the wrong track. So, to a certain extent, yes, I think there needs to be decent amount of education, information available on this, and at least push it through. I mean, down the pipe to most of the retail investors. I mean, so that at least they don't invest in F&O and I mean, and continue making losses like what they've been doing in the past. But then you really can't use a regulatory channel to stop someone from doing it, because, like I said, I mean, it's their money, they can do whatever they feel like.
Yes. So now going forward, Amrish, we've seen the elections are over, budget's over, all of that is done and dusted with. What is your outlook going forward?
See, I think this budget was more from a long-term perspective for the economy than playing to the gallery and especially the markets. So, because of which we have seen that if you look at the various provisions, clearly, I think the focus was rural, the focus was farm, the youth especially, and and especially on the employment perspective, because if you, I mean, if you look at the like the population of India, I think I mean we have more than 65% of the people who are less than 35 years of age. So clearly, I think employment is of prime importance because I mean the demographic dividend which we talk about is actually a double-edged sword. I mean, if you are able to employ the youth gainfully, then it ends up as I mean a huge increase in consumption going ahead, and which is good for the economy. But at the same time, if you're not able to provide them the right opportunities to be gainfully employed at this point of time, that can lead to social issues going ahead. So I think that's I think of prime importance, and which is what I think the government and this budget has rightly done, is focus on youth and employment. And the other thing which they have done also is, to a certain extent, I mean, bring some relief to the to the middle class, especially the salaried class. So at least there is more cash in hand as far as they are concerned, because whatever said and done, the inflation, the I mean, the real inflation at the ground level is more than what is officially being announced. And if you look at the fiscal prudence, thankfully that has still continued, and the fiscal deficit is less than what was envisaged in the budget in February this year. And if you're looking at the fiscal deficit estimated next year, still better 4.5%. So overall, from that point of view, I think it's been a decent budget.
Right. And Amrish, going forward, what would be your advice for investors, perhaps new investors who are waiting for these big events to get out of the way and then sort of look at starting either their SIPs or entering equity markets at this stage at these valuations? What is your advice?
See, valuations, no doubt, is expensive at this point of time. I mean, if you look at the Nifty valuations, which is I'm talking of the large caps and the blue chips, that is still decently higher than I mean the average. I mean, it's currently at about 23, 24 times against an average of about 18 times. But then, if you look at certain pockets, especially some of the mid cap and the small caps, I think the valuations have gone through the roof. If you look at the defense space, which has been in vogue for the last 18 months, I mean, if we talk about 4 years back, I mean, I mean, we used to find it difficult convincing people to buy it at 7x to 10x PE. I'm not talking of anything else, 7 to 10x PE. Today, people are willing to buy the same stocks at 10x revenue. So just imagine as to how the valuations have gone through the roof. So I think, I mean, when you're investing for long term, don't try and time the markets, which is the age old saying. But then at the same time, I think you should be careful in picking up the sectors where you should be investing in. And at this point of time, I mean, at least there are certain sectors where the valuations are still decent. FMCG, for that matter, I think this budget is, I mean, should give a boost to consumption, especially the rural and tier three, tier four sort of spaces where the consumption can move up because of this budget. So I think one should be looking at FMCG and consumer good companies. I think that's one space to be invested in. Other than the budget, I think IT space, from the sort of earnings which have come, at least we are seeing some green shoots. So that's the other space to be invested in. Pharma, I mean, has always been, I mean, a defensive space. So that's the other sector to be invested in. So invest in these two or three sectors. Try and avoid the high P sort of sectors where the valuations have gone through the roof, like defense, railways. I think that's to be avoided for the time being. So one should invest, but be careful.
Right. And between in the equity space, in one's equity portfolio, what would you recommend be the allocation to the different market caps, small, mid, and large caps?
No, generally the sort of, I mean, the segmentation should be like 60% in large caps. I mean, if you're not a very sort of a risky investor, then 60% in the large caps, about 25-30% in the mid caps, and 10 to 15% in the small cap. But for the time being, I would say whatever is there in the small cap and mid cap, at least the small cap book out to a large extent, mid caps book out to at least about 40-50%. And when it comes to the large caps, possibly one can hold on, but maybe book about 10 to 15% there. So overall, I would suggest that one should have about 25-30% in cash at this point of time in the portfolio.
Right. And Amrish, any thoughts on gold? Because obviously, gold, the customs duty coming down is going to
Right.
make gold much, much cheaper. And
Right.
to me, it also seems somewhere that the government is incentivizing people to maybe move away from the FNO kind of trading and perhaps put a bit more in gold because it is technically safer.
No, that's true. I mean, see, gold. If you're talking of long term, I mean that's an asset class
Yes.
which is the safest, and I think one should have an allocation of about 5% to I mean the gold portfolio, 5 to 10% depending on your comfort level. And with this today's cut in customs duty, I think the damage is already done. I think gold prices have corrected to a decent extent. Don't see it correcting too much further from here because of this. But at the same time, if you look at the long-term gold chart, I mean the way the gold prices move, I mean it moves in a certain amount of time. It moves up sharply, and then it stays constant for a decently long time, or it corrects a bit. So I think we have reached a level where it has shot up quite sharply if you see the last 6 to 8 months. And now I think the period has started where possibly it will move more sideways, or possibly, I mean, some sort of a correction from here. So I really will not suggest someone to buy gold right now if you're looking at the next possibly 1 or 2 years. I would possibly wait for the next 9 to 12 months to buy gold from a longer term perspective. But right now, it doesn't make sense to invest in gold and just wait and see it holding where it is.
Right. And finally, Amrish, just wanted another word from you on the real estate aspect, because from what I understand, real estate is going to be quite deeply impacted. The indexation benefit is been taken away. So, your sense?
Yeah, but then see, I mean, nowadays what we see mostly is that people are buying into real estate, I mean, basically for their own use than from an investment perspective. So the indexation benefits going away surely affects I mean, the investment demand. But like I said, what we see nowadays is the demand more for your own use, the end user demand. So I don't see a major negative impact of out of this, but yes, I think sentimentally it would be negative.
All right, Amrish, we leave it there. Thank you so much for taking the
Thank you.
time and speaking to us.